So basically, this new income tax bill of 2025, this is seemingly a replacement for the old Income Tax Act 1961, which has been there for more than 60 years now. And the intention behind this new act is to simplify the existing provisions of the Income Tax Act 1961. At a first look, and the act seems to be something like an onion. As you keep on peeling it off, there are new and new things which one can always start interpreting. But at a broader level, the concept, etc., contained in this income tax bill are mostly in line with what was there under the earlier regulation. What has been done is, wherever there were many references which were happening in the earlier legislation for different sections, and we're going to look at it as a part of this session today, most of them have been simplified and collected into a single place so that it becomes easier for a person to see what exactly is the complete law around this particular part. As a part of our effort, what we are trying to do here is we will be conducting certain more classes on this particular topic. Today, we are going to give you an overview of some of the most commonly made changes that have happened in the income tax bill compared to the earlier Income Tax Act 1961. So in terms of the timelines, basically in the budget speech of July 2024, the finance minister proposed that there would be a comprehensive review of the Income Tax Act 1961 to make it more simple. And in February 25, the income tax bill has been tabled in the parliament. If approved, it will become a legislation effective from 1st of April 2026 and will be applicable for financial year, as we call it right now, 26, 27 and onwards. Now, this is a broad comparison. It doesn't make any difference to the life of the taxability of various events. But basically, if one were to look at the number of sections in the new bill, I would say, are 536, divided into 23 chapters and 16 schedule. Earlier, if one were to consider or include even the subsections as sections, there were 819 sections, 47 chapters and 16 schedules in the earlier Income Tax Act. The bill basically gives a lot of tables and formula, which makes it easier for one to comprehend in terms of what is the applicability of the provision, as compared to the earlier Income Tax Act, where one had to make references to different sections. So, for example, if one were to talk about Section 79, where a change in shareholding can result in denial of carry forward of business losses, it referred to the concept of a closely held company. Now, in many of those cases, you might have to differ at different sections to find out how these are going to pan out. All the provision dealing with a single topic have been consolidated at one place. And I would say to a very, very large extent, this has been achieved. And the language is more active compared to a passive language which was there. There are a lot of these explanation and sections which have been converted into clauses in the new income tax bill. So the first change, which is again one of the simplest yet, which is something which is kind of easing out a lot of things, is the concept of previous year and assessment year has now been replaced with the concept of tax year. So earlier we had previous year, which was 12-month period during which the income was earned, or in case of a newly set up business, from the date when it was set up to the end of the financial year. And assessment year, which was a 12-month period following the previous year, when the income earned in the previous year was taxed. Now, both these terms have been replaced with the concept of tax year, which is basically a 12-month period. So the way it defines is 12-month period of the financial year commencing on the 1st April. Of course, like I mentioned, in case of newly business, there is an exception here also for a new source of income, just like it was in the earlier act. But this simplifies because this is something which is followed internationally as well. So now it becomes much more easier for any non-resident to ascertain as to what exactly is the period for which they have to pay taxes. Otherwise, the concept of previous year, assessment year has been for a long time confusing for such people. The filing of the tax return again was based on previous year and assessment year. The income earned in the previous year was offered to tax in the assessment year. Now it is all the concept have been now linked to the concept of tax year. When we look at the changes in the concept of residential status provision, the primary condition for an individual to be a resident in India, which was 182 days or more in the tax year, or 60 days or more during the tax year and 365 days in the last 4 years, these have been retained in principle. There is no change in the definition of person of Indian origin, a deemed resident, or who will be constituting a resident but not ordinary resident. The period for which and the criteria based on which a company would be treated as a resident of India again remains the same. An Indian company or a company which has its place of effective management in India would be considered as a resident of India. However, one change which has been done is that typically what used to happen was that if a person was leaving for employment outside India, right? The earlier IT Act used the word that for the purposes of employment outside India. So if an individual left for the purposes of employment outside India, this condition of 60 days was substituted with the condition of 182 days. Now the change that has been done is that the purposes word has been removed in the new income tax bill. So instead of saying that for the purpose of employment, if it says is for employment. Now there can be a varied interpretation of this particular clause, right? But one can infer from this that this might actually postulate that one should have an employment opportunity in hand when they are leaving for outside India. Now, the concept of business connection basically is applicable in cases where any income derived by a non-resident from any property in India or source of income in India or asset in India was treated as deemed to have been accrued or arising in India. Of course, this was subject to the provisions of the tax treaty. So even if the income was considered to be arising from a business connection, if it did not result from a permanent establishment, then in those cases, that income was not liable to tax in India. What has been done is that in the business connection section, it used to read that all income accruing or arising through or from any business connection in India was deemed to accrue or arise in India. The word all has now been replaced with the word any income accruing or arising. Now, if one were to look at the differences, this would rather be a singular word, which meant that some income may be there, which may not be taxable. That just kind of leaves a little bit of a gap. Whereas this used to say that all income arising from business connection would be taxable in India. One critical change, which is there for government employees, is that the taxation of salary, which was paid by the government employees who were rendering services outside India, was taxable in India only when it was chargeable under the head salaries. Now, the way it has been reworded is that any income falling under the head salaries, if it is payable by the government, will be taxable in India. The word that the income which is chargeable under the head salaries has been removed here. The next one is that in case of indirect transfer, they have removed the wording which says that shall always be deemed to have been situated in India. So, as I said, a capital transfer of a capital asset is taxable if the asset is situated in India. Right? Now, for indirect tax provision, the rule is that if there is a transfer of an asset outside India, which could be, let's say, for example, shares, and those shares derive their principal value from assets in India, then basically those indirect transfer can be taxed in India in certain cases. There's obviously a detailed exercise that needs to be done. In those cases, there was a provision that once this condition is met, then that asset will always be deemed to be situated in India. These words have been something which are removed from the new bill. Now, again, for business connection, basically one of the conditions for taxability was that if you have a business connection and you earn any income, the income which was reasonably attributable to such business connection was something which was considered as taxable in India. This now seems to have been changed, where instead of saying a reasonable attributable, they've said only income which is attributable to a business connection is taxable in India. This just reduces the scope of discretion that may be available to an income tax officer for this purpose. When we talk about the salary provisions, there are two changes which are relevant here. The first one is that when we talk about certain perquisites granted to employee, they were taxable in India in the hands of the employee when their salaries exceeded rupees 50,000. So any benefit or amenity which was granted or provided free of cost or at concessional rate by an employer to an employee, let's say, for example, a discounted interest loan, right? Something like that was taxable in case of specified employees, and specified employees basically refer to employees who had a salary of exceeding 50,000. Now, this limit came in a lot many years ago. This has been reworded to say that would now be prescribed in due course. So whether it is 50,000, 250,000, 500,000, that is something which is going to be now changed and provided in subsequently. The second change is whenever there was a claim for a medical treatment, which was paid by the employer for treatment of prescribed disease, it was treated as a non-taxable perquisite in the hands of the employee. The two conditions, however, were they had to obtain a certificate from the hospital and the receipt of payment was required to be provided to the employer by the employee. These two conditions are something that have been removed, but what has been added is that so long as this treatment is in an approved hospital, these two documents will not be required. If it is not in respect of this particular hospital, what is going to happen? That is something that has yet to be seen. In profits and gains of business and profession, certain export incentives like sale of input license, any cash assistance given by the government, duty drawback or duty remission, these were taxable under the heads PGPP. However, there was no clarity as to if there are any other export incentives which are provided, whether those will be taxable or not. The new bill now specifically mentions that any other export incentive other than these which are specifically mentioned will also be considered as a profit and gain, would also be taxable under PGPP. The second thing which is relevant is that when you calculate the actual cost of an asset for the purpose of claiming depreciation, any GST which is included in the cost of asset will not be eligible for depreciation where the input of such GST has been claimed. This is specifically something which has been added to the new bill. In case of intangible asset, now for understanding this point, we need to first understand that in case of tangible assets, if they are not used exclusively for business purposes, then the depreciation allowable on them is proportionately allocated. There was no such corresponding provision for intangible assets. What has now been done is that any depreciation which is available on intangible asset will be allowed to the extent such intangible asset is used for the purpose of business. Second is the depreciation on eligible intangible asset will be allowed irrespective of the date when such intangible assets were acquired. The next change which we've observed is that when we talk about section 43B, which deals with allowance of certain expenditure on payment basis, this section basically contained the word otherwise allowable. So what was required was that an expense, when you consider them as disallowable under 43B, should have been first allowable. And once they are allowable under general provision, if they are not paid, then by virtue of 43B, they were not allowed. When I say paid, obviously as per the due date, which might be applicable for that respective expenditure, if any. These word otherwise allowable have now been deleted. Now, this basically leaves an open point as to how this should be dealt with. Does this mean that even an expenditure which is not otherwise allowable will also be covered here? Effectively, if you see, it may not make too much of a difference from the deletion of these words, because the fact is that if an expense is not allowable otherwise, in any case, it will be disallowed. So the deletion of these words may not make too much of a change, but this is something that has been removed from the new bill. The next one is, we all disallow income tax, which is debited to the profit and loss account. But the way the provision were there earlier, it was limited to the tax paid on income under the head profits and gains of business and profession. The new bill clarifies that any tax which is paid on income will not be allowable as a deduction if it is debited to the profit and loss account. Practically, this is something which was also done until today, but just as a clarification, this is something which becomes important. From an applicability of tax audit, that is applicable for revenue above 10 crores, 5% non-cash receipt and payment criteria was there, right? But the interpretation that was allowed sometime here was whether this 5% should be applicable to the total receipts in the P&L, or it should be applicable only to the receipts under the head profits and gains of business and profession. So let's say if in profit and loss account, you have PGBP revenue, you have capital gain, and you have income from other sources. So will you take the total of this to calculate this 5%? This now has been explicitly clarified to say that only the revenue for PGBP has to be considered, and this 5% limit will be applicable to this revenue and not the total revenue which is there. The next point is relating to the carry forward of business loss. So in section 79, the provision was that if you incur a loss in year A and want to set it off in B, their change on shareholding should not be more than 49% in the year A and year B. In some cases, what happened was that, let's say the shareholders was S1, in the interim, they become S2, and in the year when the set off is done, it is again S1. The interpretation which many people used to take was, so long as the shareholding in the year when the loss was incurred and when it is set off is the same, the set off will be available. This is now clarified that from this year to this year, the change in shareholding should not take place. Even if it takes place once in the beginning or in the interim, then the carry forward will be denied. It doesn't matter whether in the next year, when you are claiming a set off, the shareholding is the same or otherwise. Now, from a capital gains perspective, the clause that, on long-term capital gain on capital asset was 20% in respect of transfers before July 23-24. This is something which has now been omitted. It may not have too much of a relevance. The reason being that in any case, that is something that will continue to be governed by the erstwhile Income Tax Act 1961 once the new bill comes into picture. In the definition of relative, where the transfer of property or asset between a relative is exempt, transfer of a asset to a lineal ascendant or descendant of the spouse of the individual was something which was exempt from tax because it was considered as a transfer to a relative. This part relating to the spouse of individual has now been modified, and it has been mentioned that any lineal ascendant, whether maternal or paternal, or descendant, whether maternal or paternal, of the spouse will be considered as a relative, right? So basically, if let's say you have lineal ascendant here and lineal ascendant here, right? So originally, this section was not clear whether the lineal ascendant or descendant of the spouse of the individual would typically cover something on the paternal side. The clarification now says that the lineal ascendant or descendant need not necessarily be on the paternal side itself, but even anything on the maternal side will be considered as relative. The next change is something which is quite significant. Here, basically, section 80M basically used to deal with a situation where, let's say, there are three companies, A, B, and C. or let's say A is an individual. If C used to declare dividend to B, and B, using the proceeds of the dividend in the same year, declared further dividend to its shareholders, then Section 80M deduction was given in respect of this dividend received from C by B and included in its income to the extent of dividend declared further. This provision now, this beneficial provision has now been removed for companies who have opted for 22% tax rate. What that means is that if a company is a manufacturing company opting for 15% tax rate, this benefit will continue to be available. But if a company is something which is covered under 22% tax rate, then if they receive a dividend in the first year and in the same year declare it further also, ATM deduction will not be available to B. For non-resident, again, there are certain cosmetic changes which have been done. For non-residents which are engaged in providing services or plant and machine on hire for production or mineral oils, there was a restriction that any brought forward losses or unabsorbed depreciation cannot be set off. This has now been changed to say that no loss can be set off or deduction can be claimed by such a non-resident. For a non-resident which is engaged in operation of aircraft or shipping business, they are allowed to offer lower income than the presumptive threshold prescribed for them respectively if they maintain prescribed books of accounts. In the current budget, there were presumptive tax provisions which are applicable for companies which are providing services to Indian electronic manufacturing businesses. In respect of these companies, the new bill contains provision that they are required to maintain books of accounts and subject to tax audit, even if they're opting for this 25% tax rate. This probably is one of the important changes that has been made. In this particular case, what they have said is that if there is a non-FII for an investor, if they incur long-term capital gain on sale of unlisted shares, the foreign exchange fluctuation benefit will also be extended to them in addition to the reduced capital gains tax rate which was available. We now move on to the transfer pricing provision. I'll just take a break for a minute. In case you have any questions, you can just drop them in the chat box. Okay, so we'll move on to the next one in case there are no questions. So when we talk about transfer pricing, this is mechanical in the sense that the new income tax bill contains section 161 to 177 as against section 92 to 92F in the earlier Income Tax Act. There are no changes in the safe harbor provision, and the definition of associated enterprise for specified domestic transaction has been something which is introduced. At a larger level, the overall provisions are the same, but there are certain clarificatory modifications which have been made in the language. Now, this is regarding the definition of an associated enterprise under transfer pricing provision. Now, if one looks at the current provisions, they used to read something like this. Subsection 1 used to mention that for the purpose of section 92, associated enterprise would mean a company which participates. So these were generic provision, right? Generic provision as in, it used to say that if you participate in the capital management or control of another company directly or indirectly, the two were considered as associated enterprise. And then there was another provision which said that for the purpose of subsection 1, two enterprise shall be deemed to be associated enterprise if they fell under different clauses mentioned here. Now, the ambiguity was whether anything which fell outside this relationship can also constitute the relationship of associated enterprise between two companies. This is something which has now been changed in the new income tax bill, because here subsection 2, which is corresponding to this particular provision, clearly says that without affecting the generality of the provision of subsection 1, which means that while all these criteria, which is specified in 162.2, will constitute associated enterprise between two companies, there could be other situations also in which two enterprise can still continue to be associated enterprise. Another two important changes in transfer pricing is that Income Tax Act currently permits the use of arithmetic mean to calculate arm's length price when there are more than one prices which are determined using the most appropriate method. So what happens here is you apply one of the most appropriate method, which could be TNMM, cup, etc. When you apply it, you get more than one price which appears to be a comparable. And in such a case, you can calculate the arithmetic mean of these numbers and use them subject to certain conditions. In the new bill, what it mentions is that if multiple prices are derived, then the arm's length price will be determined as per the manner prescribed by the board. So while the arithmetical mean word has been removed, the method which will be used will be prescribed by the board. Now, whether this is again going to include arithmetic mean or something else as well, that is something which one will need to wait for. This is one of the provisions which impacts almost everyone. The TDS provision, the good news is they have been consolidated in different categories. So the way they have been consolidated is that one section deals with TDS on payments to resident. Second deals with TDS on payments to non-resident. And there's another section which deals with TDS on payments to any person. Seems quite hot to hear today. So basically, what this does is that now instead of going back to different provisions, right, to find out what is the rate of TDS on a particular payment, you just need to go to that one particular clause. There's a detailed table which is given there, and the rates which are applicable of TDS on different payments are something which are given. All the exclusions of cases where TDS provisions are not applicable are again consolidated in a single clause. This would include the threshold below which TDS is not required to be deducted, or cases where exemptions are there. In the new provision, the provision mentions that one can obtain a lower TDS or a TCS. The word nil is specifically not there. So again, there would be issues in terms of identifying whether, the lower would include nil or not, right? One of the other things which is there across many of the TDS provision is that even if an amount is credited to a suspense account or some form of other account, the TDS liability is crystallized. Now, this provision was there in some of the cases and not in the other. This provision now has been generalized to say that credit to a suspense account, irrespective of where the TDS is required to be deducted, will require deduction. So if TDS is applicable on a particular nature of income, it doesn't matter which nature of income it is. If it is credited to a suspense account, then TDS will have to be deducted. Same with the TCS provision, even they have been consolidated at one place. Now, what are the key changes in transfer pricing? Again, one of the other changes that, if after applying the most appropriate method that we were discussing, if more than one price was determined, we saw as to what was applicable. The problem was that if most appropriate method was applied and there was only one price which was received, whether the plus minus 3% tolerance range. What is tolerance range? So one is basically the arm's length price at which the transaction is benchmarked. The other is actual price. Generally, when the difference between these two is plus minus 3%, even then also the actual price is considered to be an arm's length price. The issue was, what if only one price is determined as per the most appropriate method. In this particular case, what has been done is that if only one price is determined, even then this tolerance range of plus minus 3% will be available. If more than one price is determined, then the determination will be prescribed by the central government in the new income tax bill. Interplay of domestic law versus DTAA. Now, here basically what comes in is that a non-resident is entitled to take the benefit of the Income Tax Act provision or the double taxation avoidance agreement, whichever are more beneficial for them. And this is something which is contained in section 90, subsection 2. Here, basically, there are certain words that have been added, which says that where, okay, let's just read this part, where the central government has entered into an agreement with government of any country outside India, as the case may be under subsection 1 for granting relief of tax, or as the case may be avoidance of double taxation, then in relation to an assessee to whom such agreement applies, the provision of this act shall apply to the extent they are more beneficial to that assessee. In this particular space, the new income tax bill has added this provision, which says that and such agreement has been notified under that subsection, which is subsection 1 of section 90 is what it was there earlier. The corresponding provision in the new bill are different. For granting relief of tax or avoidance of double taxation. So effectively what they are saying is that the purpose of this double taxation avoidance agreement should be granting either a relief of tax or avoidance of double taxation. So this basically just kinds of add on more to the fact that the benefit cannot be claimed for tax evasion. The benefit can be claimed only for claiming a relief or avoidance of double taxation. Now, here comes another important thing in the context of a non-resident. Generally, the double taxation avoidance agreement typically would not contain too many definitions, 3, 4, 5, at the max 6. What is done is that for the purpose of interpretation of terms, generally which are not contained in the DTAA, the provision of the Income Tax Act are considered. If the Income Tax Act also does not contain, then basically if a notification has been issued by the central government, then that notification is something which has to be referred to. So the current process was that any definition in the DTAA would have precedence over the same definition in the IT bill. If there's no DTAA definition, then any definition provided in the Income Tax Act or any explanation issued by the central government for this will be considered. But if there is no DTAA, no act, then any meaning provided in the notification issued by the central government will be considered. But now the new bill goes one step forward. What it says is that even if there's no definition in the DTAA, even if there's no definition in the act, even there's no explanation issued by the central government, and there is no meaning provided in any notification issued by the central government, you can refer to the meaning of such a term from any tax-related act of the central government. So for example, if Income Tax Act or everything here under the Income Tax Act does not meet the criteria, but the term is defined in Goods and Services Tax, GST provisions, then you can refer to it to them. Or in the absence for them, even if something is not contained in the tax-related act, from any other central government law. However, this is subject to the fact that the context should not provide otherwise. Right? And such a meaning shall be deemed to have taken effect from the date on which the respective double taxation avoidance agreement came into force. Now, in cases where already these issues are there, the problems are there, this is something that may actually cause even more confusion and more litigation. Maybe before the bill becomes an act, there might be a clarification to say that, okay, this might not be applicable for earlier provisions, right? A general application may in any case mean that, but a specific provision on that regard may help. Now, for the PAN-related provisions, there has been a lot of action over the last few years where linking of the PAN is something that has been provided. In section 262 of the new bill, there is one modification that in case of individuals who do not have a PAN number, right, they can use Aadhaar number as a substitute for PAN. But the thing is, when they do this, then in that case, they might actually get a PAN number issued by the tax department suo motu, right? However, for individuals with PAN, where this PAN is also linked to the Aadhaar, they may use their Aadhaar number in place of PAN. Tax returns. Now, there are no such provision, no such specific provisions which require filing of return by the taxpayers due to foreign travel, turnover, etc. However, there is a power given to the CBDT to define the conditions that would make the return filing mandatory. The CBDT can request additional details from assessees. That is something which has been provided in the new bill, like bank account, credit card ownership, assets of the prescribed nature. In case of partnership, the name of other partners, if they are incurring expenditures exceeding a specified threshold, the particulars of their place of business, right? All this is something that they are empowered to ask. Now, there may be a notification that may come for this at a later stage. When we talk about the provisions relating to assessment, one thing which was there was that in case a company files an updated return for a particular year, and because of filing that updated return, there is a change in loss. So let's say you in year one, you filed a particular return declaring a loss of, let's say, 80. In the second year, you had an income of 100. Now you file an updated return here, whereby these losses are reduced to 0. If this is something that impacts your earlier next year return, normally you would be required to file a return, right? But currently, the way the provision are, it seems that this is not mandatory, and one such adjustment may automatically come into the other one. But there may be certain exceptions that might be outlined for this as to in cases where a tax might be payable in the next year or something like that. Where the return of income of an individual or a person is filed by a person under power of attorney, then the power of attorney of the authorized signatory is no longer required to be attached to the return of income. The appeal effect order has to be passed in 6 months instead of 3-month period, which was there earlier, which can be extended to 9 months. And this period will be from the month of the receipt of the order by the concerned PCIT, CIT, etc. In case of income escaping assessment, now this is also one issue that has been there for a long time, where where a notice is issued for income escaping assessment. And during the course of assessment, the income tax officer found that there are certain other income also, whether he was required to issue a separate notice for that. The new provision provides that there is no need to issue a separate notice for other escaped income, which comes to the notice of the assessing officer while he's coming with the income escaping assessment. The repeal and savings provision in the new income tax bill is something which is Income Tax Act 1961 is repealed under section 536(1). The rights and actions of the assessee and the government are reserved under 536(2), right? The existing Income Tax Act will continue to apply for tax years before April 1, 26, that is financial year 25-26. And these provisions which are dealing with assessment, penalty, revision, and appeal would continue to apply, right? So up to financial year 25-26 will follow the existing provision. However, in respect of refunds and penalties, the interest which is allowable after the effect of this act coming into existence will be the ones which are prescribed in this act, and that will be equally applicable for an assessee to pay and the government to pay. Any losses and deductions which were claimed under the earlier act can be carried forward, right? And the tax credit will be carried forward under the new law, subject to certain conditions. So this slide basically is a summary of, we've discussed most of the provisions for today. Now, this slide is basically a summary of what all is coming on your way as we are progressing with the analysis, classes, etc. of the income tax bill 2025 till the time it becomes the act and subsequently. So we would be conducting certain live and recorded classes, which will be to the up to 60 hours, which might be there, right? And then you would be, for people who would be joining us in this journey, we will be having certain commentary on Income Tax Act, which will be given in the form of a hard copies. Just like for all our existing courses, we are creating an exclusive community where people who are a part of this community can interact, ask their question, and deal with their solutions. We will be providing regular monthly updates and monthly webinars on key issues and topics from here on. And at the time when the tax return and tax audit come into picture, we will be carrying on sessions in terms of how that has to be done. So in case there are any questions with any one of you, we'll be happy to take them. Because from a content perspective, we have come to an end of the session today. These are basically the principal changes that have happened in the new income tax bill 2025. So in case there are no questions, we would end this session today. In case you have any further thing, you can always come back and post this in the message section of this app. This is the new income tax bill 2025 community, which we have. So there was a recent corrigendum which was issued, which we have uploaded this year. And any further update which might be there from our side, as well as from the news article, etc., we would be sharing the relevant information here. So stay engaged with this, and we look forward to interacting with you in the coming picture.